Okay, so good afternoon, everyone. So we have accounting for liabilities. Actually, this is not a new topic since you have been introduced with the preparations of statement of financial positions, right? You have learned from the beginning on the introductions of liabilities component, which we have current liabilities as well as non-current liabilities. Okay, so when we talk about current liabilities, are those liabilities which due, okay, within a year, due within a year. So in accounting, okay, when we talk about short term, like here we have the liabilities, right? So the obligation is within 1 year. So you need to settle the liabilities within a year. More than that, it's going to be your non-current liabilities. So in exam, you must be very clear cut. You have to know the term of the liability. Okay, like here we have example like this notes payable. It's a 9 months, so it should be under current liabilities. 3 months, current liability. If let's say it's a 9 years note payable, so it's a non-current liability. So very, very clear it will be stated. Okay. All right. The first question on theory. What are the non-current liabilities? Give 3 examples. As I mentioned earlier, if short-term liability or current liability is within a year, so beyond 1 year, we are going to group it as your non-current liabilities. It's a commitment and obligations that need to be uh, settled by the business, by the organization. It is due in the long term, right, which is more than a year. Example, we have bonds, long-term notes, notes payable, or lease obligations. In accounting, leasing is quite complicated actually. Yeah, because we have the accounting for leasing and lessor. Leasing something like rental, but the concept is different. Okay, the major difference is in terms of the ownership of the asset. When you talk about lease, Lease, maybe you walk around, you want to search for a vacant condo or vacant apartment, then you can see rent/lease. It sounds like same, but component or the characteristics, there's a huge difference. Okay. Leasing, the ownership for the finance lease can be transferred to the tenant. So if tenant prepare the accounts, right? So the depreciation will be charged by the leasee's account, not the lessor. Lessor is the landlord, the owner. Different, eh? So lease obligations, this is not a normal rental. Okay. But operating lease, yes, equivalent to normal rental. So notice this. Okay. So lease obligations, leasing normally more than 1 year. Hmm? Very hard we come across a leasing which is less than 1 year. If you have less than 1 year, normally we go for rental. Yeah, we go for rental. Okay. Different type of bonds, secured versus unsecured, convertible versus callable bond. When we talk about bonds, this is the most secured investment. But as you know, higher risk, higher return. So lower risk, lower return. The most secure meaning lower risk. Example like the government of Malaysia, the last bonds issued was on 1998. That's the last bonds. When a nation issued a bond, it shows that they don't have money. If you read the history of Greece, right? You know Greece it's already went bankrupt, right? I think now I never heard much about Greece states. I don't read much. There should be a progress now in the economy. Yeah. So it is the most secured. Secured bond have specific asset to be a collateral. Collateral meaning security. You must attach something so that you can get the money that being borrowed. Okay. So you have a concept of lend and borrow. So the person who issue bond, they wants to borrow money. They are the borrower. So the investor will be the lender. Okay. Unsecured, you don't have to attach anything. Example like those common one in the market. These bonds are called debenture bonds. Next, convertible and callable. Convertible, it can be converted into other instrument. For example, here I have, it can be converted into ordinary shares. Okay. Callable, okay, let's say certain amount not yet paid by the investor, you can ask the investor to pay something like our call up shares. Okay, the shares issued by the company. What are the major disadvantage of bonds? Major disadvantage of using bond are the interest must be paid. Okay, the interest itself, we call it as a coupon rate. Okay, bonds coupon rate. So same thing, like you want to borrow money from the bank, you must pay interest, right? So the same approach will be used for these bonds. And of course, when you have this interest, we have to differentiate between the payment of interest as well as principal. Yeah. Like me, my housing loan, I'm using the compounding interest. Let's say I owe for 200,000 because that house I bought 2005. Have you born or you just born? You just born, is it? 2005. Time still cheap lah, house in Malaysia. 200K, I have to pay nearly 500K to the bank. So it's nearly 3 times from the value of the asset. Where does it come from? The interest. Okay. If simple interest, you buy car, you buy motorcycle, we use HP, hire purchase. That one is simple interest. Like your study loan, normally also simple interest, but study loan, they plus all these lah, finance cost lah, blah, blah, blah. But our hire purchase, the car, the motorcycle is very direct. Let's say it's a 4% per year. So you have loan for 5 years. So 5 multiply 4%, 20%. How much you owe? 50,000. 50,000 multiply 20%. Simple. And then plus interest divide with the number of months that you have to pay. But housing cannot. House loan, we can't predict that way because they are using compounding interest. Okay. These are the thing about this principal and the interest payment. Two major obligations for bonds, interest payment, and as well as the principal. Exactly like loan. Huh? That's why you put under liability. Okay, question 2. I saw in the past year, most of it asked also about journal entries. So you got no choice. I believe this tutorial is very good for you, especially towards the end. Okay, you have the entry plus the extract financial statements. And normally the mark in exam is nearly 15 to 20 marks. It's a lot. Like your question 3 in a midterm. For this topic, past year question, nearly 15 marks to 20. That day midterm ask you on the cash and bank, right? Your cash book, something like. The double, so no, the double entry of the transaction. After that, you have to prepare accounts payable, account receivable, ledger, something like this. Okay. For final exam, you don't have that question anymore, but they might ask you something like this. Yeah, the liability. Okay, I have a company. It's involved notes payable. On 1st July 2024, the company borrowed 6,000 from Fort National Bank, signing a 9-month 8% note. So meaning, when you borrow money, normally the normal one, debit cash, debit bank, credit loan. But here, since you borrow the money, but you issue a note, meaning you give the notes payable to the bank. So at any time, this bank will collect the money from you because you are the one who issued this notes payable. And what's good about this notes payable? The collector, meaning the bank in this case, they will collect together with the interest charge on this notes payable. If you maintain account receivable, we got no interest charge, right? Except you want to charge late payment charges. That's it. But here, the notes payable is attached to the interest. When you have the notes payable, it was stated clearly how much is the interest for this notes payable. So in the exam, you have to look for the percentage. And this is a yearly, please guys. It is an annual rate. Okay? It is an annual rate. So meaning if I have here the 8%, this is for 12 months. Okay? Even though, you see here, written 9 months notes payable. This 8% not for 9 months. 8% is for 12 months, standard. This is how we pronounce this interest. It's a yearly interest. You don't have to divide by 9 whatsoever. Okay? All right. Next, borrow 42,000 from Livingston Bank by signing 3 months 7% note on November 1st, 2024. Again, the 7% is yearly rate, not 3 months rate. Very clear, yeah? I repeat for the last time, this 8 months is not interest rate for 9 months. It is for 12 months annually. Same goes to this one, 7% is not 3 months interest rate. It is a 1 year interest rate, yearly interest rate, annual interest rate. Sorry? We have to compute the interest later on. So you need to know how long or the period, the terms of the interest that you want to calculate, or else it will affect your answer. Because some students, they thought that this 7% is for 3 months. So if I give you a 6 months, so they multiply 7% multiply 2, 14%. No. This 7% is your annual rate. Okay. Next, December 31st, we prepare the adjusting entry. You must recall back your adjustment topic. Adjusting is involved like depreciation, computation of your interest on loan that day, interest on loan. So now is interest on notes payable. When you have this adjusting entry, it is a common practice. At the end of the month, we are going to prepare this adjusting entry. Actually, the step like this, you prepare your ledgers throughout the month, all the transaction record. After that, you close all ledgers and you prepare one trial balance. Then you will prepare the adjusting entry. After adjusting entry, you will prepare adjusted trial balance. After adjusted trial balance, then only you prepare your SOPL. You get your net profit or net loss, then you send to SOFP. After that, you can prepare statement changes of equity, statement of cash flow, and the last one is a notes of financial statement. I think some of you who did the accounting in the high school, they have this full cycle. Okay. Like here, normally in degree year, we cut. But that's the process lah. So this is the adjusting entry. Meaning it's involved, like here, computations of the interest. Have you paid? Not yet paid. We just recognize how much interest that we need to pay on 31st December. That's it. Next, pay principal and interest to the bank on 1st February. And then we have to pay principal and interest to the National Bank on 1st April. Prepare journal entries. Okay, prepare journal entries. All right, so for each transaction, the 1st July, debit cash, credit notes payable. Your asset goes up, your liability goes up. Remember, don't write accounts payable, don't write loan. Trust me, in the exam, I'm going to see accounts payable. No. Why is it notes? You see here, when we borrow money, we provide notes to the bank. So the one that you should credit is not the loan, it's a notes payable. It is a non-current liability. All right? Can you write bank? Yes, of course. Bank or cash. Both are accepted. Next, November 1st, borrow 42,000. Same thing. Cash, debit, credit notes payable. Liability goes up, asset goes up. Cannot, because it is a notes. If you want to write notes payable dash Fourth National Bank, notes payable dash Livingston Bank, that one is certain. But don't write accounts payable. Accounts payable is actually the vendor, the supplier. This is the bank. Maybe some of you may write loan, but loan also wrong. Okay, we are talking about notes payable. Okay, next, prepare adjusting entry. Then now we compute how much is the interest. For the first bank, 60,000, multiply 8%, multiply 6/12. Okay, 6/12 because end of year. So here we assume prepare general entries for each transaction end of year. So from 1st July until 31st December 2024. July, October, August. July, August, September, October, November, December. 6 months. So 6/12. You don't have 8% over multiply 9 or over 9 only now. This is annual rate. Just take it as it is. Then you apportion accordingly to the month charge and according to the question settings. So debit interest expense. So debit interest, the expense goes up. Credit interest payable. As I mentioned earlier, have you paid? Not yet paid. So let's say the next day you want to pay. What will be the double entry? Debit interest payable, credit bank, credit cash. That's it. Okay. But here they don't ask you to pay, right? So you can't see it in this double entry. Here we just prepare the adjusting entries on the December 31st. Same goes to the next bank. Okay, 42,000, the value of your notes payable, multiply 7% the interest rate, and then November 1st until 31st December. So November, December, 2 months, 2/12. Are you okay? So in this question, you have to be very, very careful on the date. Sure. Why? This is the maturity period of the notes payable, meaning when you borrow money from the Fourth National Bank, you give notes payable, you are going to settle the payment of this on this notes payable within 9 months to Fourth National Bank. You will settle the notes payable to Livingston Bank within 3 months. That's the maturity date of the notes payable. Or the due the due of the notes payable. Okay? For the next year. Okay, when is the due for this notes payable? November, December, January, right? End of January. Yes, yes, yes. And later we will see at the bottom. We got that the issue. You're right. Okay, that's on 31st December. 1st February, we need to pay. Okay, now you can see the effect of payment. So just now we owe from Livingston 42,000. Livingston, First Livingston. This one, Livingston payment. So I should take this one, 42. So 42,000. Look at the double entry. This one, right? So credit notes payable, debit notes payable. Means what? You cancel off it, right? Zero. Zero rise lah. So meaning you settle your debt, your liability. And then next, how much is the interest payable? We already computed just now. Okay, you paid on 1st February, yeah? You paid on 1st February. So 490, the interest up to 31st December. And what about the interest in January? Because we pay on 1st February. This is the question just now Abdullah asked. So what about the next month? So it will be here. Okay. So we compute the 1 month interest. Why not 2 months? Because we make payment on 1st February. If we make payment on 28th February, yes, it is 2 months. Do you copy me? Start with 1st January 2025 until 1st February 2025, 1 month. So be careful, guys, with the date. Perhaps you can highlight it carefully in the exam. So I have the 2 months, sorry, here, 1 month. So 1/12, then I get 245. So now I know how much I should pay to the bank on 1st February for these notes payable. So to Livingston, we pay 42735. You settle this, that's the way you know the credit, the payment made. You see, pay, principal, and interest. So where is the principal? This one, Some bank they call face value. Not future value, face value. Okay, done with that. 1st April, we need to pay to Fourth National Bank. How much we owe? 60,000. So go back to the original transaction. We have this one. Credit notes payable. So we debit. Then how much is the interest just now? Up to 31st December, we already computed this much. So now I have another. Yes. From 31st December up to 1st April. How many months? January, February, March. 1st April. Not end of April. 1st April. Beginning of April. Okay, careful, The common mistake in exam. So 3/12. So I compute the interest up to March 2025. So I get this. Right? Then I total up. Then I get the total amount that we need to pay to settle the principal and the interest. Yes. Actually, this one also late payment, right? Because, Fort National. Fort National is within 9 months. This one, Livingston. Okay lah. November, December, January. Okay. Just nice. 3 months, we settle. This one still within the period, 9 months. Sometimes for bank, even you late for 1 day also, they can charge you. But for car, normally very little, very minimum. But house, don't play around. You late for 1 month, oh my God, it will be compounding back for the the future years, It's very sick. So housing loan, don't play around. Okay. Number 3. On June 1st, company borrow 70,000 from First Bank on a 6-month 70,000 9% notes. Same thing. Borrow money, we don't have loan, but we have the notes payable. So you receive 70,000, so debit cash or bank, credit notes payable. Increase asset, increase liability. Okay. Prepare the entry on June 1st. Prepare the adjusting entry on June 30th. Within a month, right? 1st June, you borrow money. And then now we prepare the adjusting entry on June 30th, 1 month. So how much is the interest? 70,000 multiply 9%, right? 9%, and then multiply 1/12, 1 month only. So I get 525. So debit interest expense, credit interest payable. Prepare the entry at maturity, assuming monthly adjusting entry have been made through November 30th. It's a 6 months. Okay. So that's why November 30. June, July, August, September, October, November. See, 6 months due, right? This one, 6 months is a due. So when you pay by November 30th, this is the day it's being due. So I have to settle the payment. You see, prepare the entry at maturity. They don't say you pay the principal or interest like the previous question. But automatically you should know when you say that, prepare the entry at maturity, that's the day we have to pay. Because this is so-called a liability. And it has due. When is the due? Next 6 months after 1st June. Okay, next 6 months after 1st June. So how much is your notes payable? So we computed just now the 70,000 here. So I debit notes payable, settle. Then we compute the interest. The interest for how many months? Of course, for the 6 months. Because you borrow 1st June, you pay on 30th November. Okay, so I just simply take 70,000 multiply 9% multiply 6 over 12. Then I get 3150. So this much I pay to the bank. That's it. How much is the interest expense? Also called financing cost. Okay, in SOPL, you can write finance cost, admin cost, selling and distribution cost. So this interest on notes payable, we can categorize it as your finance cost. 3150, this one, the 6-month interest. Any question? Question number 4. On 1st January 2024, company issued 400,000 8% 5-year bonds at face value. At face value meaning when you want to reach the maturity, and when it reach the maturity, this is the value. This is the carrying amount. Later you will see bonds can be issued at discount, at premium. Whether it's discount or premium, just a comparison of the market interest rate and your internal interest rate, IRR. The one you learn in lecture, I guess. Or you can Google, very simple to understand this. But the most important thing in exam, how can you know? You have bonds issued at discount, bond issued at premium. Okay, later I will highlight on it. We got one question on this. But this one, you see, they don't mention whether it is issued at 90%, at 110%. So we don't have any issue on this discount or premium bonds. It has been issued at face value, meaning when you want to pay back, that's the 400,000 that you need to pay. No discount, no additional. Interest is payable annually on January 1st. Prepare the journal entries on the issuance of the bond. So debit cash. You borrow money, of course you get cash or bank. And then you credit the liability. Like here, I should write bonds payable. Okay, but if you write bonds also accepted, because we know that bond should be a non-current liability. Okay, and it should be your parts of liabilities. Okay, next, accrual of interest on December 31st. So 1 year. Okay, 1 year. How can I know? Because your bond has been issued on 1st January. So now end of year, right? So 12 months. So my accrual interest is the adjusting entries. Same thing, adjusting entries. So debit interest expense, credit interest payable. Of course, we're not yet paid. Yeah, adjusting entries. So 400,000, the value of the bond, multiply 8%, the interest rate also called coupon rate, and then multiply 1 or 12 over 12. You don't want to write this one also okay, because it is 1 year. No issue. You don't want to write multiply 12 over 12. It's fine. But I purposely write it, okay, so that you remember this is, you need the apportionment of the month for your interest. So debit expenses, credit interest payable. Next, the payment of interest on January 1st. The next day only we pay. So debit interest payable, this one, credit, one debit, and then credit your cash or bank. This is the one that I mentioned to you just now. This one. When you pay, debit interest payable. So one credit, one debit, settle your liability. And then credit, bank or cash. That's all for question 4. Okay, I think we go for 10 minutes break. Then we'll continue after this. Let's continue. Okay, question 5. So question 5. Provided the adjusted trial balance for a company at the end of current year contain the following accounts: interest payable, lease liability, bonds payable. Prepare the non-current liability section. Very simple, right? Meaning extract of SOFP lah. Okay. So we just need non-current liability, which involve your lease liability and bonds payable. Interest payable is a current liability. Question asks non-current, non-current, okay, non-current liability. So only my bonds payable and lease liability. Do not include your interest payable. It is a short-term liability. Within 1 year, you must pay your interest. Okay, question 6. On January 1st, 2024, the ledger of Shumway Limited contains the following liability accounts. Okay, accounts payable, sales tax payable, unearned service revenue. And then what is this unearned service revenue? You must recall back your adjusting entries or adjustment topic that day. Alright, this is the service which you charge your customer but you not yet perform the service. You charge this service revenue, meaning your customer pay in advance. Then later only you provide the service. So that is unearned service revenue or prepaid revenue. Okay, prepaid revenue is a liability, current liability. So basically, when you talk about this unearned service revenue, the nature balance should be on credit because it is a liability account. During January, the following selected transaction occurred. Okay, and then we are going to generalize the January transactions, generalize the adjusting entry for the outstanding notes payable, and prepare the current liability sections of your SOFP extract. Okay, so first one, we generalize each transaction. January 5th, sold merchandise for cash totaling 22,470, which includes 7% sales tax. My question, this 22,470 is already included the sales tax or not? What do you think? You read the statement, 22470 is already include sales tax or not? Already. Shiwe? Already. Miss Lam Lam? Xiao Lam, is it your name? Included? No. Included. Any answer with not included? Wen Hao? What do you think? No idea? Try. Give a try. Not included. Okay, that's good. Are you sure not included? Why? That's how you see the question, is it? All right. Actually, it's already included because it's mentioned there. We sold goods for a cash 22470, meaning you collect from your customer how much? 22470, which includes 7% sales tax. Meaning this 22470 represented 107% of the total sales. You agree with me? 100% is the sales. 7% is the sales tax. So 107% equal to 22470. 107% equal to 22470. Can I know how much is the 100%? Yes. Can I know how much is the 7%? Yes. Okay. Why it's important? Because you need to know how much is the sales tax. Why you need to differentiate between your sales revenue and your sales tax? The sales tax, you just collect it on behalf of the government. Example, like normally we pay to the Custom and Excise Duty Department. So we collect on behalf of the customer, like what you paid lah. You went to restaurant, many of them charge you sales tax, right? So this sales tax, it's not the restaurant owner take it as their income. No, it is the national income. So they just collect on behalf of the government. That's why you see sales tax payable. Because we collect, after that we will pay to the government. Normally lump sum. But inside your receipt, you can see, right, how much they charge to the customer. Sales tax, service tax. Service tax, sometimes the restaurant owner also can take because they provide service. The sales tax, it is indirect tax. And government will collect from the customer. So, debit cash or debit bank, credit sales revenue. So how much is the sales revenue? It's actually the 100. So you settle the maths, okay? Or you can also use this way, 22470 divide with the 107%. Or you learn in high school, right? Cross multiplying. You know, right? Cross multiplying. This multiply this multiply this. Then settle your maths. Okay. So my sales revenue is 21,000. So the tax, we collect 22470 from the customer. So the difference is actually the sales tax. Or you can proceed also with the computation. 100% equal to what? Or 107% equal to 22470. 7% equal to X. Then cross multiplying as usual. Maths. Okay? So you get 1470. That's all. So clear cut, you need to know whether this amount stated in the question, is it already included the sales tax or not? Okay, next. 12th January, perform services for customers whom had made advance payment of 10,000, which is, this is from your service revenue, this one. Now you perform the service. You already collect the revenue in advance. Okay. So now only you charge this revenue. So that's why you credit service revenue. So you will debit your unearned service revenue. Unearned service revenue is credit balance, liability. When you debit unearned service revenue, meaning your liability reduce. Okay? So 10,000, debit unearned service revenue, credit service revenue. Next. Paid revenue department for sales tax collected in December. This is the one, the payment made by the restaurant owner or the company owner to the revenue department, to the government lah, so called. Okay, so debit sales tax payable, here you credit, okay, then here you debit. But here we pay for 5,800, which is this amount, okay, in December 2023. This one is beginning of the year, I have this balance. So we pay this one first, okay, this one. So debit sales tax payable, credit cash or credit bank. Okay, careful December 2023. So I should take this one, not the new one, not this one. Not yet paid. Next, sold 700 units of a new product on credit. When I have word on credit, what does it mean? You have receivables. Okay. So how much is the account receivable value? 700 multiply 52 plus 7% sales tax. Or make your life easier, you can straight away determine from here. How much is the sales revenue? Your P times Q, your price 52 multiply unit. 52 multiply 700, so you get 36,400. So 7% is your tax not yet paid. When how? From here, can you know? There's no sales tax value, right? Because I don't even know my revenue here in this question, in this transaction, sorry, in this transactions. So I compute the revenue. Then only I can compute the sales tax, which is 36,400. This one, 700 units multiplied 52 ringgit, you get 36,400, which is your revenue. And then 7% is your sales tax. So you get 2,548 sales tax. So sales revenue plus sales tax. So you get your account. That's it. Okay. On 21st, borrow 14,000 from the bank on a 3-month 8% 14,000 note. So we borrow from bank, we provide the notes payable. So debit cash, credit notes payable, like the previous question. Sold merchandise for cash totaling 12,947, which include 7% sales tax. Well, now, is it included, the sales tax already? Yes, no? Yes. Because the word which includes, that includes 7% sales tax. Very good. So merchandise for cash totaling 12,947. So you collect 12,947, debit cash or bank. And then your sales revenue, so should be 12,947 divide with 107%, or you can go by cross multiplying. Okay, you will get 12,100, the 100% revenue. So 7%, how much? 847. Okay, or you can also use this approach. Yeah. Okay, same thing. So 12,947 minus 12,100, we get 847. That is your sales tax. Okay. Prepare the current liabilities. Oh, sorry, journal. Part B. Journal for adjusting entry. Your interest expense. When? January 31st. Outstanding notes payable. So notes payable, we have this one, right? Only one. And transaction on 21st. So 21st January, we make the borrowing. We have the borrowing. We have to compute the adjusting entry on January 31st. 1 month. So 1 month interest. Okay, so 14,000 multiply 8%, multiply 1 month over 12. So we get 93. This is adjusting entry, not yet pay. So debit expense, credit interest payable. Okay, debit expense, credit interest payable. Then your extract SOFP for current liability parts. I think all is current liability, is it? Accounts payable, sales tax, some of it paid already. This one also some already utilized. Our notes payable also is a 3 month. So all of it. So notes payable. Notes payable. No changes. Only one. Credit 14,000. So 14,000 here. Accounts payable. No payment made, right? On this accounts payable, you see, assume no change in accounts payable. So I can just simply take this one, 52. 52 for accounts payable. Unearned service revenue, we have 13,000. And then just now, we already charged 10,000. So credit, debit, set off. 13,000 minus 10, left 3K. I put here. Sales tax payable, we have this one, 1470, 2548, 847. Yes, only three total. So 4865. And the last one we have the interest payable. And then you total up, so you get 73958. Okay. Question? Number 7. Something like final exam question. It's not. The following are selected transactions of a company. Prepare financial statement quarterly. So we have all the transaction. We need to prepare the journal entries for the transactions. Post to the accounts, notes payable, interest payable, and interest expense, something like your midterm that day. Show the statement of financial position, presentation of notes and interest payable as at 31st December. And then what is the total interest expense for the year? Okay. Journal entry, January 2nd. Purchase merchandise on account. What is purchase merchandise? In midterm, I receive your purchase good, then you put debit goods account. We don't maintain that anymore, yeah. We maintain the movement of stock. You only have purchases if you buy stock. If you sell merchandise, it's not credit goods account, not credit inventory account. It should be credit your sales account. If you have goods written from your customer, return inwards. If the business return goods to the supplier, return outwards. Okay, I don't have this debit inventory, credit inventory anymore. Yeah. So debit purchases. You purchase merchandise, meaning you purchase goods. Your stock inventory. Okay. Sambung the merchandise. So debit purchases, 30,000. Credit accounts payable 30,000. Why? Because we purchase on account, on credit. The best one, you write accounts payable dash early. In midterm, some students just write accounts payable. I accept. Full mark. Some students wrote early only. Also full mark. Some students wrote accounts payable dash early. All accepted. All correct. All are correct. Okay. But of course, when your liability goes up, it should go to the credit side. If you put debit, then wrong. Okay. Next. Issued a 6% 2 months 30,000 notes to Ali in payment of account. Okay. You purchase from Ali on 2nd January. On 1st February, you decide you want to issue a note. What note? Payable. Notes payable. Perfect. Okay, notes payable. So I will debit accounts payable Ali, the same amount, and then I will credit this notes payable. We just interchange it. Okay. Sometime on the day of the transaction itself, like here, the company issue the notes payable to the vendor, to the supplier. But you may come across a situation whereby, you see, you bought on 2nd January, following month, 1st February, then only you issue your notes payable. So what will be the effect? This is how it looks like. Are you okay? So I cancel off my accounts payable. Now I have the notes payable. That's it. 31st March. Accrued interest for 2 months on Ali notes. What's the logic? You issue these notes payable, okay, to Ali on 1st February. End of March, you want to prepare the adjusting entries. So 1st February, end of March, so 2 months. Can you see? How do we derive the 2 months? Okay, so now I prepare the adjusting entry for the interest on the notes payable for 2 months. So debit interest expense, your expense goes up on debit. Credit interest payable, we not yet pay. We record it only at the end of the month. That's common practice for the company. All adjusting entry, we don't make it in the between of the month. Normally end of month. Eh? So 30,000, the value of your notes payable. Multiply 6%. And then it's meant for 2 months, right? So 2 over 12. So I get 300. Okay? Next transaction. 1st April. Paid face value and interest on LE notes. What does it mean? Now you settle the notes payable. Okay, you make payment. Face value meaning this is the amount. Your carrying value equal to the face value, no changes. Later we will see the bonds, this one, then different price. Okay, so I want to settle this notes payable. So your notes payable on credit, 30,000. So of course, I want to settle, make payment on this notes payable. I'm going to debit notes payable. Same amount, 30. Because at face value, the same amount you owe, the same amount you settle at the end of the maturity. Okay? And then how much your interest payable just now? 300. Okay, 300. So stated here, and interest on LE notes. Right? So we settle the interest. So debit 300. This one, same. So how much you pay actually? 3,300. You can have credit cash or credit bank. Both are accepted. That's on 1st April. 1st July. Purchase equipment from Clark Equipment paying 8,000 in cash and signing a 7% 3-month 40,000 note. Partly pay by cash, partly by notes payable. Okay, so how much is your equipment? 48,000. How much you pay for cash? 8,000, stated here. How much your notes payable? 40,000. Okay, even written here. It's not stated also, you can read it already if they give you the value of the equipment. Let's say purchase equipment 48,000, paying 8,000 in cash and signing the 7% 3 months notes. Can I know how much is the notes payable? Of course. They give you 48,000, you pay by cash 8,000, so the balance belongs to the notes payable. Okay? September 30th, accrued interest for 3 months on Clark notes. You see, we purchase equipment from Clark 1st July. So July, August, end of September. So September, 3 months. So we compute the interest. 40,000 is the value of your notes. Multiply 7%, multiply 3 over 12. So debit interest expense, credit interest payable, adjusting entry. Okay, when you have accrued interest, meaning adjusting entry. Okay, next. October 1st, paid face value and interest on Clark note. Face value meaning this one. Okay, 40,000. So on 1st October, debit notes payable. This one, 40,000, 40,000. And then debit interest payable. This much, right? The one that you want to pay. So a total amount, 40,700. Credit cash or credit bank. December 1st, borrowed 50,000 from the Jonas Bank by issuing a 3-month 6% note with a face value of 15,000. So debit cash, credit notes payable. You see everything like repetition, you know, for this question. If you get the juice, so easy for you to get 15 to 20 marks in the final. Okay? But I believe that no point you memorize, you should know why debit, why credit. Then easier. Okay? No choice lah. If you say last result, you memorize. It's all. But I don't dare, you know. Last time I did that. Then I realized accounting is very tough. Then when I work, I say, why everything is repetition? And my senior say, of course, you just have 6 accounts in this world. Why you think we got 6 million accounts? Something is all repetition, you know. Repeat, repeat, repeat. So sometimes some people feel like it's not challenge. Not challenge enough for their career enrichment. Okay, December 31st. Recognize interest expense for 1 month on Jonas Bank because we have this notes payable on 1st December. So end of month, 31st December, 1 month interest. So you compute the interest, 15,000, the notes payable value, multiply 6%, the interest, this one. Okay. And then we multiply 1/12. That's all. That's for journal entries. Post to notes payable, exactly like your midterm. After you have your double entry, post it accordingly. Even though during midterm, I saw magic. Journal entry is correct. Come to ledger, all goes wrong. Here, no details. Supposedly, there should be a details. Example like notes payable. And this one, 30,000. We post accordingly all this. You see? Accounts. That one is a comparison. Notes payable. Notes payable. This one. Credit, notes payable. So I go to notes payable. Credit side. This one. Then put date. Actually, you must write the details. Accounts payable early here. Should be like this. But here is simplified lah. But I don't advise you to do this simple in the exam. Please write the details. No. This one for my marking scheme. This is not. Yes, frankly. In accounting, your details must be correct. Your amount must be correct. So put the details, okay? Like 7 January. 7 January. Oh, 1st of July. You see, the date is confusing also if you put like that. Notes payable 40,000. Right? So what debit? Equipment. Meaning when I see this notes payable, it is on credit, meaning my liability goes up because I borrow from Ellie, because I bought equipment. You see? That's why the detail is very, very important. During midterm, I close eyes. Students don't provide details. They don't even write the date. They just write the amount. Credit, debit. I both eyes, I close. I give full mark. Final exam, not sure. But not recommended at all. Okay, please write in full. Then this one is the, what is this? 1st December, is it? Where got 1st December? Now I'm confused. 15,000 notes payable. Oh, this is the balancing figure. This is the balancing figure. Okay, then any debit. Here, debit, you see? 1st April, notes payable, 30,000 debit. So, this one. Cash. Right? And then what else we have? 40,000. Debit, debit, debit. Notes payable, debit. This one and this one. 1st October. So, also cash. Meaning we paid by cash or bank lah. So, credit side 70. And then debit side 70. Oh, this one no more balance. The closing balance. The balance. And we have this one. Oh, 1st December. Oh, this one lah at the bottom lah. Cash. This one. Credit. Okay, notes payable, credit. That's why you don't write the details. It's very confusing. Okay. So your closing balance is 15,000. Interest payable. I have this one. This one the credit. So 31st March. 31st March on credit. This one 300. So what's the detail? Interest expense. Okay. What else? On 1st April, debit 300. 1st April, debit, cash or bank. And then we have this one, September 30th, credit interest payable. Okay, 700. And then on 1st October, we pay. So debit interest payable. Cash or bank. Okay, and the last one, we have this one. Faizullah, what are you doing there? Okay, interest expense. Get your interest expense. Just post accordingly, your double entry. But if your journal is wrong, of course, everything goes wrong lah. So interest expense, I have this one. 300, 775. Then we put here accordingly. Okay. Like here, interest payable. All is interest payable, I guess. Betul. The ledger. Show the statement. SOSP as extracts or notes and interest payable. So notes payable, how much left? 15,000. Interest payable, 75. That's all. How much is your total interest? Total interest is this one, your interest expense. Okay. Okay, why got this thing? 1075. That's all. So easy. In final, you can get 50 to 20 marks. Give it. Question 8. On May 1st, 2024, company issued 600,000, 9%, 5-year bonds at face value. Face value meaning this is your carrying amount. Okay. The bonds were dated May 1st, 2024 and pay interest annually on May 1st, on each May 1st. Financial statement prepared annually on December 31st. Be careful with this question. Because we got 2 dates here. Your bond, the bonds is on 1st May 2024. Your financial year ended or your period should be 1st January 2024 until 31st December 2024. So bonds, if you take as how many years? It is a 5-year bonds, right? So annual bond. 1st May until 30th April 2025. 1-year bond. Okay. So now prepare journal entry to record the issuance of the bonds. Debit cash, credit bonds payable. This one very direct. Just get from here. Why I take 600,000? Because this bond issued at face value. Okay, so my face value, this one. I don't have different carrying value at the end of year 5. Okay, be careful. Bonds. I saw final exam, most of it come out bonds. Okay, next. Prepare the adjusting entry to record the accrual of interest on 31st December 2024. Why 31st December 2024? Because you prepare financial statements. Your year end is on 31st December 2024. So how much is your interest on these bonds? So double entry, debit interest, interest expense goes up, expenses increase on debit, credit interest payable. 600,000, the value of your bonds, multiply 9%, the interest rate, multiply 8 over 12. Why? Because you have the bond from 1st May 2024 until 31st December 2024. Don't count until here because your year end 31st December. Do you understand? Some students, They give me 12/12 because it is an annual bond. You are right. But now I ask you to compute the accrual of interest, the adjusting entry on 31st December 2024. So your bonds period for year 2024 takes place from 1st May 2024 until 31st December 2024, not until 30th April 2025. Understood? Follow, eh? Okay, so I get the 8/12. That's all. Next, show the extract of statement of financial position presentation on December 31st, 2024. So my interest payable, this one, current liabilities, your liabilities, and then your bonds payable, 600,000. You see, all these are normally with 1 mark or 2 marks in the final exam. Next, prepare the journal entry to record the payment of interest on 1st May 2025. 1st May 2025 meaning 1 year, right? 1 year period of bonds. Okay. So firstly, assuming no accrual, so your interest payable just now we already computed, right? This one, 36,000 up to 31st December. So 36,000. So now from 31st December, computed already, 36, 36,000. Now they ask you to compute up to 1st May 2025. So how many months? There's another 4 months, not 5 months, okay? Because 1st May. January, February, March, until end of April. Because 1st May, not 30th May, not 28 or whatsoever May. Okay? So it should be a 4 months. So here we compute the 4 months interest. 600,000 multiplied 9%, 4/12, which is the interest up to May 1st, 2025. 18,000. So how much you need to pay for the interest? 54,000. Then at the bottom here, I show you lah. This thing. Prepare the adjusting entry to record the payment of interest on December 31st, 2025. So interest expense, actually this is we get computation first. 600,000, the value of your bond, multiply 9%, multiply 8/12. Why 8/12? Because from 1st May 2025 until 31st May 2025. Okay. Carefully, So I might confuse student. So I get 8 months. May. You must compute the May because this one is up to 30th April and it's stated here. You see the payment of interest up to May 1st. So that's why I must compute May, June, July, August, September, October, November, December. 8 months. Okay? 36,000. Done. This question is similar to past year question, yeah. But the only thing is it's shorter a bit. They give you a short transaction, but similar. Okay, the last question. Question 9. Presented below are two independent situations. First one, we have the bonds. Okay. This is the one that I want to discuss about this. Bond issue at discount, bond issue at premium. Okay, first situation. We have the bonds, 380,000 on June 30th, 2024 at 102. You see? At 102 and immediately retired them. Retired meaning you must pay lah. You have the bond, after that you pay the bonds. What is this at 102? Meaning your bonds has been issued at premium, more than 100%. Actually, that one is 102%. How do you know it's a discount bond? Okay, like here. Company purchased 400,000 of its bond, meaning they issued bonds. 96 at 96, less than 100. So meaning that bond being issued at discount. The difference between this discount and premium is the treatment of your market interest rate and your interest rate, internal interest rate. Okay, so let's see the double entry. The carrying value of the bond on the retirement is 371,500. Now you can see we have this word, carrying value of the bond. The previous question we don't have. Previous one we always have face value. The bond at face value. So your carrying value and the cost of the bond at the beginning of your bonds period, same. Exactly the same. But when you have a different value, it will state it clearly. Carrying value of the bond during retirement, during the maturity date is 371,500. Meaning this bond is not valued 380. It's valued at 371,500 at the end of its maturity period. Okay? Like here so happen, we have bond, after that, immediately retired them. But even though there's a gap between few days, it can be this different. As you know, the share market, right, is instantly changed within a day. Okay, so this is double entry. Bonds payable, this is the amount of your bonds. This one. This is what we call as face value. Okay, this face value. 380 is your face value. So debit bonds payable, we want to pay. You need to pay because you immediately retire them. Retire them meaning you pay. So debit bonds payable. This one is a balancing figure. Hold on. You go to the credit side. Okay. First you find how much is the discount. Okay. Discounts on bonds payable. Your face value is 380. 380. After that, my carrying value is 371,500. So that's a difference. So difference I should put on the credit side. Because your value of the bond being reduced. Okay, so I should go to the credit. Don't go to the debit because debit you already put your bonds payable, the amount, the carrying, not carrying, the face value. So reduction in the value of my bond, I put it on the credit side. Actually, it's the opposite of your liability actually. So now my cash, how much you pay? 380,000 multiply 102%. That's why this percentage of the premium bond is very important to be known. You should know. So your face value multiply your issuance at premium. So the amount that I should pay, 380 multiply 102%. 387,600. So this one we get, this one we computed, and then we minus with the face value. That's a difference. Like here, the double entry, my credit is more than debit. So if you have debit lesser than credit, you have loss on bond redemption. The other way around, here we have bond issued at discount. After that, this is your carrying value. Okay, so same thing. First, your bonds payable, your face value, 400,000, you debit because we want to pay. And then we compute the discounts. Okay, the discount, which is your face value minus the carrying value. So I get the 5,000. So that's the discount. Okay. And then how much I pay, I compare with my face value and this one, the 96, the bond issued at discount. So 400,000 multiply 96%, 384. So this is the amount that I'm going to pay. Okay. So this 400,000 on debit, 5,000 on credit, 384 on credit. My credit lesser than debit. So meaning I have gain on bond redemption. This is a balancing figure, 11,000. This thing is a bit complicated, but it's fine. As long you memorize the step lah. Okay, let me, because loss increase on debit, profit increase on credit. Remember? The day one, I show you A, L, and E. Sales more than expenses, revenue more than expenses, you have profit. Profit increase your equity. Equity increase on credit, profit must increase on credit. If you have loss, your expenses more than your revenue. Loss will reduce your equity. Equity reduce on debit. Loss reduce on debit. Sorry, loss increase on credit. Yeah. Okay, let me just show you very fast on the what? Past year. It's not a new things that being tested. I think this paper okay. So on the past year question, see how many marks? 5, 7, 9, 13, 15 marks, guys, for this topic. 15 marks for past year question. 25, including this one. 10. This one, another topic. Accounting for equity. You see the question? Similar to your tutorial. On 1st January, Doji Berhad issued 800,000, 6%, 5-year bond at face value. This one no issue on the premium or discount. Not a big deal. Interest is payable semi-annually. What does it mean payable semi-annually? Meaning the interest on this bond paid twice a year. On 1st July and then another one on 1st January. Prepare journal entry to record issuance of the bond. Debit cash, credit bonds payable. You see one tick, 1 mark. It's not half mark or 0.025. Then, very technical kan. This one's very direct. You lost 1 mark, it's just simple as you don't know the double entry. Next, payment of interest on 1st July, assuming no previous accrual of interest. So you compute the interest. 800,000 multiply 6/12, multiply 6 months because 1st July, right? So from 1st January until 1st July, how many months? 6 months. Very simple. And then, next question, they ask you to pay. Oh no, adjusting entry. Okay, adjusting entry, or this one the other way. Our tutorial, adjusting entry first, after that the payment. So adjusting entry. So debit, bond interest expense, credit, bond interest payable. Another 6 months because you pay already 1st July, you haven't paid, you see, December 31st. You already paid this one 1st July, meaning from 1st August until December 31st, not yet pay. Another 6 months, right? So 6/12, same thing lah, which is you can take same working from here. That's all. Okay, let's see the next question. On 1st March, company borrow 90,000 from bank, signing a 6-month, 8% interest bearing note. What is this? Notes payable. Okay, notes payable. Prepare the entry on 1st March when the notes was issued. So debit, your cash or bank. Credit, notes payable. Exactly your tutorial. Next, prepare adjusting entry on 30th June. In order to prepare the semi-annual financial statement, assume no other interest accrual entry have been made. When is your notes payable The date is 1st March. So March, April, May, June, 4 months. 4 months interest. So 4/12. Then get the value, get the interest. That's it. Adjusting entry, not yet paid. Remember, adjusting entry, not yet paid. It should be, you recognize your expense, you credit your liability because not yet paid. Don't credit cash, please. Okay, next. You see similar? Oh, I can say exactly a tutorial. Prepare adjusting entry on August 31st to accrue the interest. So here you already declare up to June, right? So now, July, August. Another 2 months. July, August. So 2/12. Same thing. Debit interest, credit interest payable because we prepare the adjusting. You see? Adjusting. It's also adjusting. But the date's only different on the date. Prepare the entry record to the payment of these notes at maturity. You settle everything. So notes payable, debit, interest payable, this plus this. You want to pay, right? So you must close all account. Notes payable on credit, here debit. Notes interest payable on credit, here debit. And then we pay. That's it. 9 marks for that. Exactly. I think there's no excuse saying that you don't know the thing. Only thing you must repeat and repeat your exercise. From now, not the day before my exam day. Gonna. Okay, except you are having this brilliant type and genetically proven, then that's it. I know some people, they sleep, they get smarter. All right. I think that's all for today. Thank you very much to bear with me on this 6. Some of your friends didn't turn up. They are busy with the assignment. Okay, that's all. Thank you, Himalif.